Welcome back to Market News. I'm your host, and today, July 13th, 2026, we're looking at a market that's grappling with something it rarely sees this many things at once. US-Iran tensions are back in the headlines, geopolitical risk is rewriting energy narratives, AI remains the dominant equity theme even as stocks wobble beneath it, and on the small cap side, we saw something that will show up in trading journals for weeks. Let's dig in. If there's one headline that defined the session, it's the resurgence of US-Iran war fears. The broader market closed lower overnight as that geopolitical overhang weighed on sentiment across the board. The S&P 500, the Nasdaq Composite, and the Dow all ended the day in the red. Now, there's a twist here worth unpacking, because the Dow actually finished with a rare positive session, closing at 52,900.07, up 1.14%, a notable outlier in a sea of red, while the Nasdaq Composite closed at 25,832.67, down 0.80%, and the Nasdaq 100 took a sharper hit at 29,329.21, down 1.61%. The catalyst behind the geopolitical jitters was a headline from Washington. President Trump announced that the United States would take over the Strait of Hormuz and charge a 20% toll on passage through that critical choke point. It's an aggressive posture, and the energy sector's been on edge since. You could feel the anxiety rippling through the market. ExxonMobil saw some upward movement on the day, and crude oil futures responded as well, with CL=F showing the kind of moves you get when traders start recalibrating for supply disruption risk. It's a reminder that any threat to global energy flows has a way of putting a bid under oil almost reflexively. Meanwhile, there's another political thread worth flagging. Market chatter is suggesting that Trump would support a Russia sanctions bill championed by the late Senator Graham. Now, Senator Graham's passing has sent ripples through Washington, and this may complicate the GOP legislative agenda in ways we haven't fully mapped out yet. And on top of all that, there was the news that Graham's death may further complicate GOP plans going forward. It's all very much political flux, and for investors, political flux translates into more whipsaw action in risk assets. Now, let's talk about where the real conversation among analysts is happening, and that's the AI and semiconductor space. This is an area where conviction and caution are at war with each other on the same desk. On the bullish side, S&P analyst Dan Ives called memory chips the golden child of the AI revolution, pointing to a 15-to-1 demand-to-supply imbalance that, if anything, is hard to argue with. Jim Cramer agreed in spirit, saying South Korea is mispricing SK Hynix and that he's still very bullish on AI memory. Those are two respected analysts, both leaning hard into the AI memory narrative despite everything else going on. Google parent Alphabet is turning its TPU chips into a standalone AI compute business. That's a structural shift, not a short-term play. Arista Networks earned a higher price target. Chevron is launching an AI data center power venture. Fortune 500 companies are flocking to open-source AI adoption. These are all pieces of a very large, very long AI build-out that continues regardless of any single week's market action. But then you look at the price action and it tells a different story. Nvidia, the poster child for the AI revolution, closed at 194.83, down 1.39% on very heavy volume of 142.4 million shares. TSMC reported a 36% sales jump as memory stocks plunged, mixed signals, frankly, and the market seemed to react by selling off Nvidia and AMD, who both fell more sharply than the broader market. Broadcom also took a larger-than-average hit. Oracle stock slumped. Intel declined more than the market. Even names like Meta and Netflix got caught in the broad sell-off. Alphabet itself saw a more significant dip than the broader market, even though it's building TPU infrastructure. It's a paradox. The narrative is stronger than ever, the capex cycle is accelerating, but the stocks aren't always cooperating on any given afternoon. And Salesforce changed its investment story after a major U.S. Air Force fleet deal, a reminder that even government spending on AI and cloud infrastructure can be unpredictable. Now, not everything was bleeding red. A number of defensive and consumer staples names held up well. Walmart edged higher versus Costco, with analysts pointing to its defensive positioning and AI integration strengths. MasterCard, Comcast, Pfizer, and Johnson & Johnson all advanced even as the broader market slipped. These are the kinds of names investors gravitate toward when the mood turns risk-off, and they are a useful barometer of where institutional money is seeking shelter. On the utilities and energy side, Enbridge secured over $28 billion of growth capital projects for dividend investors, which is a large number and a strong signal for yield-focused investors. ONEOK was highlighted for its more than 30-year streak of dividend stability with a 4.7% yield. These are the kinds of income stories that quietly compound in the background while everyone is watching mega-cap tech tickers all day. PepsiCo is facing mixed second-quarter results with a Circle K tie-up that could reshape its North American profit strategy. It's a nuanced story, but one that's worth following through the quarter. And in the retail space, the Walmart versus Costco debate continues, with Walmart getting the nod for defensive coverage right now. The small cap and micro cap universe, as always on a day like this, went wild. BCPC surged nearly 600% in a single session. CLRO more than doubled, jumping 101%. CWD leapt 90.6%. YRD was up nearly 60%, DSY over 55%, ROCWA up about 41%, and the gains kept going down the list. On the other side, TC down nearly 39%, LTX down 37%, LI down 36%, AMX down 35%. These are small and micro-cap names, and the single-day volatility is extreme. One day you're up, the next day you're in different territory entirely. It's the kind of market that rewards extreme caution or extreme conviction, rarely anything in between. Technical breadth tells a story consistent with what you saw in the headlines. Out of 10,640 symbols analyzed, the bullish signals were outnumbered by bearish signals nearly 2 to 1, with only 16 bullish versus 34 bearish among the categories tracked. That's a thin, risk-off tape, and it helps explain why even the AI stalwarts couldn't hold their ground. The top bullish signals included GDC, PAVS, ALIT, NU, and QNCX, all showing strong momentum upside. On the bearish side, BFLX, CELO, KTTA, PU, and RNWWW were flagged for overbought conditions and potential overextension. The daily volume profile confirmed that this was a big session. The Nasdaq Composite and the Nasdaq 100, with their 9.5 billion share volumes, showed how much money was rotating through the index names. At the company level, beyond NVIDIA 142 million shares, AAL moved 130 million, T moved 129 million, and CWD handled more than 338 million shares of microcap volume, which is almost unheard of and a testament to the speculation happening in that corner of the market. So what's ahead? Investors are positioning for what is shaping up to be a major earnings week. JP Morgan, Bank of America, and Goldman Sachs are all reporting, the big three Wall Street banks, giving us a window into credit, trading, and investment banking health at a moment of geopolitical uncertainty. That's going to be a heavy data point for the sector and for the macro picture. The CPI print is on the docket as well, and with bearish signals outnumbering bullish ones 2 to 1, that inflation data is going to get read very carefully by anyone trying to guess where the Fed might go next. The broader takeaway for today is this: geopolitical risks are front and center. Energy markets are pricing in real danger premiums. AI and semiconductors remain the structural narrative of this cycle, but the market is showing nerves and the technical setup is not friendly. Defensive positioning is in the wind. Bank earnings and inflation data next week will either confirm that this is a healthy correction or start painting a different picture altogether. That brings us to the end of today's episode. I'll see you tomorrow for another round of market news.